Mortgage rates are a key factor in determining how much you'll pay for your home each month. They're not just numbers on a page, they directly impact your budget, your lifestyle, and even your long-term financial goals. Whether you're a first-time buyer or a seasoned homeowner, understanding how these rates work can make a huge difference in your financial well-being. Even a small change in rates can save or cost you thousands over the life of your loan. For example, a difference of just 0.5% in your interest rate could mean paying significantly more or less over 15 or 30 years. That's money you could use for your children's education, a family vacation, or investing in your future. When rates are high, monthly payments rise, making homeownership harder for many. Higher rates can push some buyers out of the market entirely, or force families to settle for less than their dream home. It can also mean less flexibility in your monthly budget, making it harder to save or invest elsewhere. Lower rates, on the other hand, open the door for more people to buy and make it easier to qualify for a loan. With lower monthly payments, you might be able to afford a bigger home, or simply enjoy more breathing room in your finances. It can also mean more buyers in the market, which helps neighborhoods grow and thrive. Homeowners also watch rates closely, often refinancing when rates drop to save money or pay off their home faster. Refinancing can be a smart move, especially if you want to lower your monthly payment, shorten your loan term, or tap into your home's equity for other needs. Refinancing can free up cash for other needs, or help you pay off your mortgage sooner. It's a way to take control of your finances, reduce your debt faster, or even fund important life goals like starting a business or sending your kids to college. Whether you're buying or already own, understanding mortgage rates is crucial for your financial future. Being informed helps you make better choices, avoid costly mistakes, and plan ahead with confidence. The housing market and rates are always shifting, so timing matters. Economic changes, government policies, and even global events can cause rates to rise or fall, sometimes quickly. By tracking these trends, you can make smarter decisions about when to buy or refinance. Staying up to date with market news and working with a trusted advisor can help you spot opportunities and avoid pitfalls. A lower rate can turn homeownership from a dream into reality, or make your current home more affordable. It can mean more money in your pocket each month, and less stress about making ends meet. As of November 2025, there's good news. Rates have dropped, creating new opportunities for buyers and owners alike. This shift could mean the difference between waiting and finally making your move. Now is a great time to explore your options and see how these changes could benefit you. Whether you're looking to buy your first home, upgrade, or refinance, understanding mortgage rates puts you in control of your financial future. November 2025 brought the lowest mortgage rates in over a year, a major win for buyers and homeowners. The average 30-year fixed mortgage rate fell to 6.24%, making homeownership more accessible. This drop means lower monthly payments, sometimes saving buyers hundreds each month. While the 15-year fixed rate ticked up slightly to 5.51%, it remains attractive for those wanting to pay off their home faster. The key takeaway: falling rates are creating real opportunities for those ready to act. Understanding these numbers helps you see how much you could save in today's market. Mortgage rates are often discussed in basis points. 1 basis point equals 0.01%. In November, the 30-year rate dropped by 2 basis points from October, but the bigger story is the year-over-year change. Compared to last year, the 30-year rate is down 57 basis points, saving homeowners significant money. The 15-year rate, despite a small monthly increase, is also down 52 basis points from a year ago. These drops translate to real savings, potentially tens of thousands over the life of a loan. The trend borrowing costs are down, making now a better time to get a mortgage than last year. Mortgage rates often follow the 10-year Treasury yield, which is considered a key benchmark for long-term borrowing costs in the United States. When investors and analysts want to understand where mortgage rates might be headed, they frequently look to the movement of this yield as an early indicator. The 10-year Treasury is seen as a reflection of investor confidence in the economy, and its yield can influence everything from home loans to business financing. In November 2025, the 10-year yield was 4.09%, up slightly from October. This small increase might seem insignificant, but even minor changes in the Treasury yield can ripple through the financial system, affecting the rates that homebuyers and homeowners see when they shop for a mortgage. These shifts are closely watched by both lenders and borrowers. Interestingly, in this period, mortgage rates actually fell even as the Treasury yield rose. This is a reminder that while the two are linked, they don't always move in perfect sync. Other factors, like how much risk lenders are willing to take on, the overall economic outlook, and competition among banks, can all influence the final rate offered to borrowers. Lenders typically charge more for mortgages than for treasuries to compensate for the extra risk they take on. Unlike government bonds, mortgages can default, and borrowers' financial situations can change, so lenders build in a cushion to protect themselves. Think of the Treasury yield as the foundation of a house. Mortgage rates are built on top of that foundation, with additional layers added for things like credit risk, the health of the housing market, and broader economic conditions. Each layer adds a bit more to the final rate. Even small shifts in these rates can reflect larger trends in the economy, such as uncertainty about inflation, job growth, or global events. For families and individuals, these changes can impact monthly budgets and long-term financial plans. The takeaway? While the 10-year Treasury yield is a valuable guidepost, mortgage rates are shaped by a complex mix of market forces, lender decisions, and economic signals. Understanding this relationship can help you make smarter decisions when it comes to buying or refinancing a home. The spread is the gap between the 30-year mortgage rate and the 10-year Treasury yield, a key indicator for the housing market. In November, the spread was 2.15 percentage points, wider than the usual 1.5–1.8% range seen in more typical years. A wider spread signals lenders are cautious, reflecting uncertainty about the overall economy or job market conditions. If the spread narrows as confidence returns, mortgage rates could fall even further for buyers. For now, the wide spread means rates are lower, but not as low as they could be in a more stable market environment. Watch the spread for important clues about where mortgage rates might go next. With mortgage rates at a yearly low, both buyers and current homeowners are making moves they may have put off for months. The drop in rates has sparked a wave of renewed interest, with many people eager to take advantage of the more favorable conditions. For some, it's the perfect time to finally start searching for their dream home, while others are looking to improve their financial situation by refinancing. Mortgage applications are on the rise, signaling a boost in confidence across the market. Lenders are seeing more paperwork come through as buyers and homeowners alike look to lock in lower rates before they potentially climb again. Adjustable rate mortgages and refinancing options are especially popular right now. Many homeowners are eager to reduce their monthly payments or tap into their home's equity, while buyers are exploring creative financing to stretch their budgets further. Home sales are climbing. October saw existing home sales reach an 8-month high, a clear sign that more people are feeling confident about making big moves. Lower rates are giving buyers more purchasing power, making it easier for them to qualify for loans and close deals on homes that may have been out of reach just a few months ago. While new home sales data is delayed, early signs suggest that builders are seeing more interest in foot traffic in their developments as buyers look for fresh options in a competitive market. The bottom line is clear. Lower rates are fueling more activity, optimism, and movement in the housing market, bringing new energy to neighborhoods across the country. As more people take advantage of these conditions, momentum is building, and the housing market is showing signs of real strength heading into the next season. What does all this mean for you? Simply put, it's a window of opportunity. Lower rates make homeownership more affordable and put more homes within reach. Buyers can afford more or enjoy lower payments. Homeowners can refinance and save. With sales rising, acting now could help you secure a home before competition heats up. Refinancing could free up cash for savings, debt, or home improvements. Despite some market uncertainty, the trend is positive for consumers. Do your research, talk to experts, and consider your options. This could be the perfect time to make your move in the housing market.